AT&T continues to steal more market share from Verizon. In this video, I will give you my favorite stock out of these two. And like I said, we're seeing Verizon really lose a bunch of market share since 2018. We've seen AT&T's market share go from 33% to 47% in the wireless carrier space. So this is a huge change, drastic change. What I'll do in this video is I'll go over the financials, the fundamentals of each of these stocks. I'll compare and contrast the financials for each of these stocks, and I will give you my favorite stock out of the bunch at the end of this video. Also, I will give a price prediction for both of these stocks. So, in conclusion here, yes, AT&T is continuing to garner more and more market share within the wireless carrier space. And then with that being said, though, let's talk about AT&T from a fundamental standpoint. Then I'll cover the financials. So AT&T offers a sustainable high dividend yield with good earnings and cash flow coverage. Recent financial performance shows positive revenue growth and customer additions in the mobile and fiber segments. The company's dividend is well covered by earnings and cash flows, making it an attractive pick for income-oriented investors. And then regarding its most recent financial performance, AT&T has reported about 1 month ago, and they reported that Q3 earnings, which were actually above estimates both on revenue and the bottom line. So this is a good quarter for the company that led to a positive share price reaction, of course. Its Q3 revenues amounted to about 30 billion, which is up 1% year over year, boosted by subscriber growth due to the company's rollout of 5G and fiber that is making it more competitive in the marketplace. In Q3, AT&T was able to add on a net basis more than 468,000 customers, which is a quite positive outcome given the fierce competition from T-Mobile and Verizon. Indeed, as the US telecom industry is broadly maturing, customer gains come mainly at the expense of market share increases, making it quite hard for the three largest players to gain customers on a recurring basis from quarter to quarter. In recent years, T-Mobile has delivered higher customer growth in the wireless segment due to strong investment in the 5G rollout and some other perks for new subscribers, while AT&T has reported positive numbers, while Verizon has really been that. And then with that being said, just kind of talking about the fundamentals here. So AT&T has reported improved orders, and its business prospects in the short term seem to be a positive due to its strategy for growth in mobile and fiber, which is bearing fruit through net customers. So with that being said, let's talk about the financials for this company. Let's start off with the dividend here, though. So the dividend yield is at about 6.9%. So they have a payout ratio of 44%. And we can see that Fintel ranks the dividend safety as a C minus, the dividend growth as a C, and the yield as an A, right? Because that is a pretty high dividend yield at 6.9%. But the payout ratio is pretty high as well at 44%. So definitely worth noting there. And then let's talk about the financials for this company. So the valuation is pretty cheap right now. We have a 6.5 times PE. And when we take a look at AT&T's 5-year average, they have a 5-year average of 8 times. So definitely, cheaper than the company has been when you take a look at its own history. And then on a price to book basis, the company has a 1 times price to book ratio, which is roughly in line with its 5-year average. For those that don't know, that basically tells you that the market cap is trading in parity with the book value of this company. Book value just being assets on its balance sheet, equipment, cash, that sort of thing. And then we can take a look at the growth for this company. We can see that the revenue growth over the past 12 months has been only 1%, so not a great number there. And the forward revenue growth is actually projected to drop 10%. So we're projected to see a drop of revenue of 10% over the next 12 months. That's not a good sign, obviously. And then the 5-year average for revenue forward growth has been minus 3%. So unfortunately, we're seeing a drop that is actually steeper than we have seen in the company's history. So growth doesn't look great for AT&T. And then let's take a look at the profitability metrics. So we can see that they have a gross profit margin of 59%. Gross profit just being what this company makes for what it sells, basically just revenue minus cost of goods sold. So 59% is a okay number. It's actually above their 5-year average. So as I said, this company is improving on their profitability metrics. Unfortunately, though, I see a net income margin of minus 9%, which is worse than their 5-year average. So don't love to see that. But we can see that EBIT margin, earnings before income taxes, is actually 21%, which is above their 5-year average of 18%. So pretty solid number there. And then we can see that their EBITDA margin is 34%, which is above their 32% 5-year average. So profitability overall looks solid. And we do have cash per share of about $1 per share. And then with that being said, let's take a look at what Wall Street thinks about AT&T. So AT&T has 12 bullish ratings on Wall Street. They just have one bearish rating on Wall Street. So overall, Wall Street is more bullish than they are bearish. So that's interesting to see there. But with that being said, let's take a look at Verizon. So when we take a look at Verizon's fundamentals, I'll just make a couple points here. So Verizon reported mixed financial results in Q3 of 2023, their most recent earnings report, and they reported a decline in EPS and total operating revenue. The broadband sector showed robust growth with significant net additions, which compensated for challenges in other areas. And then Verizon unveiled a challenging financial landscape in Q3 of 2023 with a notable decline in earnings per share and total operating revenue compared to Q3 of 2022. And net income also showed a slight year-over-year decline, but a small increase in consolidated adjusted EBITDA, suggesting resilience in the company's core earnings power. Despite these mixed earnings results, Verizon broadband sector displayed robust growth with significant net additions, a testament to the strong demand for the company's broadband and fixed wireless services. And then with that being said, there are some risks for this company as well. So Verizon is susceptible to interest rate hikes and inflationary pressures, which would obviously hurt the business, which can elevate borrowing costs and impact customer spending power, which potentially would reduce demand for telecom services. And then additionally, the economic environment characterized by recession fears might dampen investor sentiment towards the telecom sector. Traditionally seen as a defensive but sensitive to broader market trends, this sensitivity to the economic climate can directly influence Verizon's profitability and stock valuation. The robust growth in the broadband sector, along with the increase in wireless service revenue, underscores Verizon's successful adaptation to market demands and consumer trends. But with that being said, let's take a look at the dividend here. So we have a dividend yield of 7.2%, which is actually above AT&T's dividend, and we have a payout ratio of 54%, which is also above AT&T's payout ratio. So Seeking Alpha here ranks out Verizon as a C plus in terms of dividend safety. Dividend growth, they rank out as a B minus, dividend yield at an A minus, and dividend consistency at an A. So overall, this dividend does seem decently safe and is very attractive relative to the broader market. 7.2% is a monster dividend. And then with that being said, let's take a look at the valuation for this company. Let's take a look at the financials as a whole. So we have a 7.6 times PE, which is actually cheaper than Verizon has traded over the past 5 years. So Verizon's 5-year average for PE has been 10 times. So we're at 7, which obviously signals that we are trading cheaper than we have in the stock's history. And then price to book is at 1.5 times. For those that don't know, that basically tells you what the market cap is relative to the book value of this company. So 1.6 basically tells you that the market cap is roughly 50% higher than the book value of this company. Book value just being, assets on its balance sheet, which is really just cash, equipment, and kind of those sorts of things. And then Verizon's 5-year average is 3.1 times for price to book ratio. So we're trading a discount. We're also trading a discount relative to PE. So valuation standpoint, we are trading at a discount relative to Verizon's own history. And then when we take a look at growth, we kind of understand why we are trading at a discount. So we have revenue growth of minus 1%, and that is below their 5-year average of plus 1%. So unfortunately, growth slowed over the past 12 months. But over the next 12 months, we're projected to see growth at roughly flat levels. So that's a stark contrast from AT&T, which is projected to drop 9% in terms of revenue over the next 12 months. So that is what I'm seeing there. And then we can see that EPS growth is actually at 7% right now, which is well above their 5-year average of minus 1.5%. So growth in EPS looks solid as well for this company. So growth overall definitely looks better than AT&T. And then let's take a look at the profitability metrics here. So we have a gross profit margin of 58%, which is roughly in line with Verizon's 5-year average of 58%. So basically right in line there. And then we have a net income margin of 15%, which is slightly above Verizon's 5-year average of 14%. So overall, from a profitability standpoint, I do believe Verizon's in a very good spot. And then what does Wall Street think about this stock? So we can see here that there are 8 bullish ratings for Verizon on Wall Street, and there are 3 bearish ratings on Wall Street for Verizon. So overall, this is a bit more of a battleground stock, which really just means that there's a wide range of opinions on Wall Street. And you can kind of compare that to AT&T, which is basically a screaming buy. You're seeing 12-1 in terms of bulls to bears on Wall Street. So that signals to me that the stock is a favorite on Wall Street, AT&T being a favorite. And that's a stark contrast to Verizon, which is more of a battleground stock. And then with that being said, let's compare and contrast these financials to each other. So let's start off with balance sheet, which I didn't cover yet for each of these companies. So we can see that Verizon has $4.3 billion in cash on hand. And we have that equals out to about $1 per share in cash. And we have $178 billion in debt. So, obviously this is a capital intensive business. That's not super shocking. But we do have a debt to equity ratio of 179%. So that definitely signals that we have a good amount of debt relative to equity. And then cash for AT&T is about $7.6 billion. So almost double the cash position of Verizon. And then we have total debt of $162 billion, which is below Verizon's debt. So we have a total debt to equity of 135% for AT&T, which is much better than Verizon's total debt to equity ratio. So overall, Verizon compared to AT&T here, in terms of the balance sheet, I would give AT&T the nod as the better balance sheet. And then let's take a look at the profitability metrics for AT&T and Verizon. Believe it or not, they're actually quite similar on gross profit margin. So Verizon has a 59% gross profit margin, which is basically right in line with AT&T. The only major difference here is EBITDA margin is the same as well. The major difference really lies within the net income margin. The net income margin for Verizon is 15%, and the net income margin for AT&T is just minus 9%. So from a profitability standpoint, I would have to give Verizon the nod once again. And then growth-wise, let's look at the growth numbers. So year over year, we've seen a decline for Verizon. Year over year, we've seen an increase from AT&T. But what's concerning for AT&T is we see a minus 10% drop for revenue as a projection over the next 12 months. And Verizon is projected to be roughly flat. So that signals to me that Verizon's growth metrics are going to be more favorable over the next 12 months. And then if we even take a look at the last 5 years for this company, so Verizon's 5-year compounded annual growth rate has been roughly 0.5%. AT&T has been minus 6% over the past 5 years as a compounded annual growth rate. So that's obviously not great. And then even if we look at the 3-year compounded annual growth rate for EBITDA, we can see that EBITDA has grown 3% for Verizon over the past 3 years. And then unfortunately for AT&T, it's down 8%. So once again, I have to give the nod in terms of growth to Verizon. That's just a logical um, conclusion to make. And then from a valuation standpoint, we can see that AT&T is trading cheaper. On a price to earnings basis, AT&T is trading cheaper. And we also, on a price to book basis, AT&T is trading cheaper as well, with Verizon at a 1.58 price to book and AT&T at 1.1. And then PE for Verizon is 7.8 and AT&T is 6.5. So I'll give the valuation nod to AT&T. So now is for the drum roll, please. Which stock of these two do I like the most? I have to go Verizon. And first off, before AT&T shareholders start to sound off on me in the comments, I think both of these stocks are worthy of capital. I think both of these stocks are good long-term investments. I give the nod to Verizon because the balance sheet looks better. Even the dividend is actually better. The growth is better. The profitability is better. Obviously, the balance sheet is slightly better for AT&T, and the valuation is better for AT&T. But it's honestly pretty close, to be frank. Just because AT&T is gaining more market share, as I had covered early in the video, they're gaining more market share over the past couple years in the wireless carrier operator space. So it was definitely a tough call. It's not an easy call to make. But I think when you take a step back and you look at the financials, Verizon is the better stock to own, in my humble opinion. Will it perform better? Obviously, do your own research in D&D. I'm not a fortune teller here, but it's my humble opinion that Verizon will perform better over the coming years. I like both of the stocks, though. I like both of the dividends even, but I like Verizon's dividend more. I like their growth metrics more. I like their profitability metrics more. Therefore, I am bullish on Verizon more than I am bullish on AT&T. Like I said, though, AT&T still a solid stock, not hating on the stock as a long-term investment. But with that being said, let's talk about the charts here. So I'm going to give a price prediction for Verizon and AT&T. So from a technical standpoint, and this is just a technical price prediction. This isn't a long-term end-all be-all prediction, purely making my predictions based on the chart here. So Verizon looks pretty solid on the chart. We actually moved above all daily moving averages for the first time since April, just over the past couple weeks. So we have a bullish momentum signal. We're above all daily moving averages. I believe we see Verizon continue to break out, and I think we probably see Verizon move up to about $42, 42.5 over the coming months for the stock. So I think Verizon gets a good run over the coming months. Obviously, do your own research, but it is worth noting that we are overbought according to RSI, so it could get somewhat of a short-term pullback for Verizon. And then I'll take a look at the seasonality trends here. So this year shows me which months are best for Verizon stock in terms of performance. So in its 39-year history, December has been one of the best months for the stock, is the fourth best month for the stock. So in December, shares typically rise 1.3%. And then obviously in November, we're basically flat for the month. So overall, bullish seasonal trends in January were also more than not positive as well. So from a seasonality standpoint, it does look as if Verizon will continue higher, and based on that chart setup. AT&T is a bit different setup, unfortunately. So we're coming up to test the 200-day moving average, and it looks like we'll probably reject that level, as this 200-day moving average coincides with resistance at around $16.20, which is roughly where shares had topped out on the 3rd of November of this year. It's also where shares roughly topped out in June and July of this year, where shares had topped out in September of last year. So I expect this level of resistance to continue to act as resistance for the stock. And I think we probably see a move down lower to about $15.50 for this stock over the coming weeks, as this is just where the stock had bottomed out in mid-November. It's also where the stock had topped out in September. So past resistance acts as new support. We saw that here in mid-November. I believe this $15 level acts as support once again for this stock. So I think we come down to 15 bucks for AT&T once again here. So definitely bullish long term on this company, just making a prediction based on technical analysis. And then over the 30-year history, the 39-year history for AT&T, November is typically a bullish month, so that's worth noting. On average, shares rise about 0.6%. And then in December, shares rise about 2% on average. So overall, it's a bullish seasonal trend for AT&T. So with that being said, I hope you enjoyed this video. If you got something out of this video, please leave a like and subscribe. Helps out the channel a bunch. I do a bunch of research on stocks, put a bunch of time in. Would help a ton if you could leave a like and subscribe to my channel. With that being said, I hope you enjoyed this video. I'll see you here next time.